While ticking lower in the second quarter, one can only assume that we've got both global and local factors equally coming to bear here.
Absolutely. Just a point to bear is we must remember that this index is actually a derivative index. Therefore, despite the fact that it is lower, any score above 50 does still mean that the view that CEOs believe that the next 6 months economic activity will be better than the previous 6 months. However, that said, I do think that it's representing concerns among CEOs and I suppose investors throughout that whether this economic slow patch that we're going through is transitory or whether in fact there is real concerns about a double dip recession.
Let's hone in specifically onto local factors here.
Yes.
I mean, what are some of the issues on home ground that are sitting front of mind for the South African CEO?
You know, locally we've had a few bunglings regulatory wise. We've had the delay of the Companies Act, which has led to a cascading effect on all the transactions coming through. We've had the suspension of Section 45 of the Income Tax Act, which has scuppered a few deals and may endanger a few empowerment deals. And of course we have the question of nationalisation back on the table, and this is obviously making foreign and local investments a bit more wary, and I think making confidence a bit more shaky. Added
to that, we've got labour unrest that persists, and you know, we can only assume that this is going to set to exacerbate the situation moving forward. That influencing perceptions right now about market conditions, which took a particular dive in this index. I mean, it's hit the lowest it's been since the third quarter of 2009, and that would impact the views about the overall economy moving forward. Is it influencing levels of investment in light of all of that?
I think it definitely is, and the local factors aside that we just discussed, of course there is the global factors, and you know, we have the QE2 in America coming to an end, and the question of whether debt levels must be lifted. We have the sovereign debt crisis in Europe continuing with Greece's imminent restructuring, and we also have disruption from the earthquake in Japan and China's self-imposed slowdown. So all these factors together, really, the same way they affect the markets and the financials, are affecting the confidence.
To what extent, you know, is adequate finance part of the problem, or acquiring adequate financing part of the problem? You know, what are the views on companies' ability to actually raise capital in current market conditions?
It's an interesting question, because a lot of the companies are finding that they are slowly feeling a bit more positive about that aspect of the index than other aspects. However, there's still not easing of credit policies, and we know that there is a buildup of cash, and I think that's where the companies are feeling that soon the sitting on the cash by the lenders will have to happen. That'll have to be distributed, but it's still slowing. Is
there any distinction that needs to be made between the various sectors in that regard, and you know, who's feeling a little bit more upbeat than some of their counterparts?
Sure. Obviously all the sectors score different scores, and we found that the industrial sector scored, I mean all the sectors dropped, but the industrial sector actually dropped the least and was actually the highest scoring of all the sectors overall. And this might be representative of the fact that they feel that they've bottomed out before the other sectors, and they will soon be again on the upcycle.
Well, in line with that, I mean, CEOs' confidence in their own, company growth prospects remained relatively flat. So it's not all doom and gloom that's out there. How much of that confidence level, though, is riding on how soon we're set to see the rate tightening cycle begin in South Africa? Well,
the fact that the index is forward-looking for only 6 months, I would suggest that that's not really much to do with the rate, the tightening. I think the question of company growth, it's often a bit of a bias for CEOs, because they feel like that's something more within their control, whereas interest rates and everything else is not really in their control, and therefore we find that the company growth question often scores higher on the index.
Just where over the 9 quarters this index has tracked the ALSI, closely, with exception of the divergence that we saw in the third quarter of 2010, is that correlation largely intact?
That correlation is perfectly intact except for that quarter, yes.